everyone. I am Smriti Bhatia from My Forex. Welcome to the second part of the webinar on top 10 tools to manage treasury for exporters and importers. In the first part, we had explained what are forwards, futures, options, buyer's credit, and supplier's credit. Now, in this part of the webinar, we discuss about export LC discounting, export factoring, packing credit, foreign currency term loan, and last but not the least, swaps. Let us start with the sixth tool, export LC discounting. It is discounting of export bills or invoices under USAN's letter of credit. This discounting is done on a post-accepting basis. The financier needs to have some credit appetite on LC issuing bank to avail this discounting. The funds are made available to exporters bank via various banking channels. The process flow of export LC discounting is very simple and is as follows. Exporter enters into a contract with the buyer. Then he approaches banks in India for indicative pricing. Once the pricing is confirmed, the buyer's bank transmits the LC to the exporter's bank via domestic financing bank, which provides a copy of the same to the supplier. Exporter shifts the goods and submits the documents at the domestic financing bank's counter. The domestic financing bank then checks and sends the documents to the buyer's bank for acceptance. The buyer's bank then provides acceptance to the domestic financing bank, guaranteeing a payment on the due date. The domestic financing bank discounts the bill and makes the net payment to the exporter after deduction of a discount. On maturity, the buyer's bank makes the payment to the domestic financing bank. This is a very simple procedure through which exporters can discount their bills and receive the payment. The next tool we have for exporters is export factoring. Factoring is a form of financial transaction in which a company buys a debt or invoice from another company. The process flow of factoring is very simple and is as follows. The seller, that is the exporter, sells the goods and raises the invoice. Then the seller approaches the factor and sends the invoice for funding. The factor then pays up to 90% of the invoice value to the exporter. Then the buyer makes the invoice payment to the factor. Once the factor receives the invoice payment, he then makes the remaining payment after deduction of factoring fees or commission to the exporter. The factor here assumes all the risk of the foreign buyer and makes sure that the seller receives the payment. Factoring and discounting sound very similar to exporters, although they have key differences, which are as follows. In discounting, trade debts are supported by account receivables, while in factoring, the factor buys entire trade debts of the client. The entire bill in discounting is discounted and paid when the transaction takes place, while in factoring, maximum amount is paid when the transaction takes place and the remaining amount is paid at settlement. Discounting is only recourse, while in factoring, the exporter has the option of recourse and non-recourse. Now let's move on to the eighth tool of export packing credit. Packing credit is a pre-shipment credit for working capital needs of exporters for the procurement of goods. Packing credit is available for various foreign currencies such as dollars, pound, euro, yen, as well as in rupee. There are two types of packing credits. Packing credit in foreign currency, which is PCFC, and packing credit in Indian rupee, which is PCINR. In PCFC, we finance at internationally competitive interest rates. The rate of interest in PCFC are linked to LIBOR, and we have a choice of currency in PCFC among dollars, pounds, euro, yen, etc. The period of PCFC is based on the export trade cycle, which is usually up to 180 days. In PCINR, the credit is availed in Indian rupee, although the future receivables are still due in foreign currency. PCINR is denominated in higher interest rates since interest rates in India are much higher than foreign interest rates. This allows exporters to retain the option of hedging and receive premium on forward hedging. Now let us compare PCINR with PCFC. As you can see, we have made this table in which we have MSMEs and non-MSMEs. MSMEs and non-MSMEs are given interest subvention in which they are provided a deduction in the interest rates. Let us now compare what is the total cost in case an exporter avails PCFC and what is the total cost if he avails PCINR. If an exporter avails PCFC, he receives a 6 months LIBOR of around 0.25, on which he gets a spread of around 2 to 2.5%, which leads to a total cost of 2.25 to 2.75 here. While in PCINR, if there is an MSME, it will have an interest rate of around 8 to 9%, on which the MSME receives an interest subvention of around 5%. If the MSME books a forward contract, he receives a forward premium of around 4%, which provides further deduction in cost and leads to 0% total cost. In a non-MSME, also, the interest rate is around 7.5 to 8.5%. Non-MSME's interest subvention is of around 3%, and on booking a forward contract, they receive a forward premium of around 4%, which leads to a total cost of 1.5%. As you can see, if an exporter avails PCINR, he has to pay a cost of around 1.5% to no cost as compared to a PCFC cost of around 2.25 to 2.75%, which is why it is usually advised to exporters to avail PCINR instead of PCFCs. Next tool we have is foreign currency term loan. Foreign currency term loan are available to both exporters and importers. These are basically long-term foreign currency loans and are available in 4 currencies: dollar, pound, euro, and yen. The interest rate on foreign currency term loan is set as per the applicable LIBOR rates. The purpose of foreign currency term loan is mostly for funding the import of capital products. It can also be used for repayment of current rupee term loan or repayment of existing external commercial borrowings. The advantage of foreign currency term loan is that it is availed on lower interest rate, since interest rate in foreign currency is usually lower than INR interest rates. Also, the spread over the interest rates are often linked to the credit score of the borrower. Therefore, if you have a strong credit score, the spread will be smaller. Another advantage of foreign currency term loan is that it can be used for repayment of high cost rupee loan using low cost foreign currency term loan. There is one risk which is there while availing foreign currency term loan, which is exchange rate fluctuation. But exchange rate fluctuations can be hedged using forward contracts. Then, last but not the least, we have swaps. Swaps include exchange of interest or principal in one currency for the same in another currency. Swaps are used to hedge against currency and or interest rate risk. That is, they can be used to hedge currency risk, to hedge interest rate risk and to hedge both currency and interest rate risk. Swaps help in converting high cost debt to low cost debt. That is, a debt taken in INR interest rate can be converted to low cost foreign currency interest rate using swaps. Pricing of swap includes LIBOR plus or minus a spread. There are three kinds of swaps: principal only swap, interest only swap, and full currency swap. In principal only swap, there is exchange of principal in two currencies. The exchange of interest payments are fixed, and this swap covers only the exchange rate risk. In case of interest only swaps, there is exchange of interest cash flows in one currency. Interest only swap includes a fixed leg and a floating leg. That is, in one leg the interest rates are fixed, while in other leg the interest rates are variable. This swap covers the interest rate risk of the exporter or importer. Then last, we have full currency swap, which is the combination of principal only swap and interest only swap. In full currency swap, exchange of both principal and interest in two currencies takes place. This swap is used to cover both exchange rate risk and interest rate risk. With this, we end our webinar. I hope you all gained a lot of clarity on the tools available for exporters and importers to manage their forex risk. If you have any further queries, feel free to reach out to us through research@myforexsite.com, and you can also contact us on 777-1009-009. Thank you.